hope you are all doing super well. The new module that we are starting with is called Year-End Adjustments, and it deals with transactions that are recorded right before the end of the financial year, important transactions that will have an effect on how we disclose certain assets and income and expenses on our financial statements. All of these transactions are recorded in the General Journal, and this module is super important for you, for your future as an accountant, because it also forms quite a big part of the Form 4 and Form 5 syllabus. But don't worry, we're going to take it slowly. We're going to do it adjustment by adjustment every week, starting with depreciation calculations this week. Before, it is the fact that some fixed assets decrease in value over time. Now, if you think about it, assets do not keep their value for forever. Sometimes you buy an asset, but when you want to sell it, you can't sell it at the same value because of certain reasons. And the reasons are wear and tear. Okay, so for example, if you bought a piece of equipment and you've been using that piece of equipment for 3 years and you can't sell it for the same value that you bought it at because you've used it. And it's now, maybe the battery life is not that great. Maybe some of the functions have been lost. If it's a computer, maybe some of the keys are not working, or the computer is slower, or the hard drive, something's wrong with the hard drive, or whatever, just because you have used it. Then another reason might be because some assets become obsolete, in other words, out of date. Okay, so especially in this very technological era that we are living in, sometimes you buy an asset, let's say you bought an iPad in 2011, and now in 2020 you can't sell that iPad for the same value that you bought it at because things have changed so much. The software of that iPad is very out of date. It's not compatible with the newest iOS systems. It can't communicate with your Apple TV or your MacBook or your phone via AirPlay. Sometimes, well, 2011 is not that far back, but maybe there wasn't Bluetooth on the iPad or whatever because technology has changed so much. Okay, so then by default, an asset decreases in value because it's just old, or because of usage. So if you think about your car, let's say you bought a car at the beginning of the year, and then by the end of the year you have driven 100,000 kilometers. Maybe you're a sales rep, and suddenly that car is not worth as much as it was when you bought it because of the amount of times that you've used it. Okay, so it's now used, and therefore you can't sell it at the same value. It's not brand new anymore. Okay, so this decrease in value is called depreciation. Depreciation is calculated at the end of the financial year. Depreciation is recorded as an expense for the business. Now, next week, we'll deal with the recording of depreciation, but what it comes down to is that every year, the amount that an asset lost in its value is written off as an expense in that specific year. So we say it decreases the business profit for that specific year because you've used the asset in that year. And by doing that, we spread the cost of an asset to the business over a few years. But this will make more sense when we do the recording of the depreciation, and even more sense when we start to do financial statement. There are two methods to calculate depreciation, so this is what we will focus on specifically in this slideshow. Equipment, vehicles, and machinery depreciate, so these are the fixed assets that we will focus on because they are the ones that actually depreciate. And then land and buildings appreciate. You might have heard your parents said sometime that land and buildings is a big investment because land and buildings increase in value over time. You might buy a piece of land for 800,000 Rand now, and in 5 years' time it might be worth 2 million Rand. Okay, that's what we call appreciation, but we don't deal with that at school level. If you become an accountant or a CA, which I hope you will, then you will deal with this in university. Important definitions that I just quickly want to run through for assets is you need to know that assets are possessions of the business and we can convert them into cash at any point in time. In other words, we can sell them. We've got non-current assets, which we will focus on. These are the assets that stay in our business for longer than 12 months. And we've got tangible assets, which means it's the assets that can be physically seen or touched, okay, like our equipment, vehicles, furniture, land, and buildings. Once again, these are the ones that we will focus on with depreciation. A business also has intangible assets. Now, these are the things that we cannot touch, and because it's such a weird concept, we don't even deal with this at school level. Well, I'm not sure, but when I was a matric, we didn't touch intangible assets. We dealt with that when I was in university, but it's like the goodwill of your business or the trademarks of the business or the patent rights. Then the lifespan of an asset is the physical life of an asset. Now you will know, especially like with your phone or your computer, companies make computers to last only for a specific period of time. So computers doesn't last forever, phones don't last forever, and sometimes we even think that Apple or Samsung or Huawei or whatever deliberately makes your phone's lifespan only 2 or 3 years to force you to buy a new phone. Then the useful life of an asset is different to its lifespan. The useful life is the time period that the business is expected to use an asset. So when a business buys a vehicle, okay, the business must record in what we call an asset register how long they expect to use this vehicle for. Okay, so maybe if it's a delivery van, they plan on using it for the next 5 or 7 years. Then redundant just means that when an asset is not usable anymore, it must be disposed because it's redundant to the business. It has no use to the business. And a replacement cost is when a business has to go and do some research on how much it will cost to replace one of their assets. In other words, what is the market value of a new asset? Definitions. The reason why I'm going through this is because remember, one of your 2 papers that you write at the end of the year is a theory paper, and definitions is a nice thing to ask in a theory paper. So depreciation is assets decrease in value over time, and then I've written there that it is an imputed expense because we allocate part of the cost to a specific accounting period. I tried to explain this to you earlier, but once again, it will make more sense when we do the recording and the financial statements. Accumulated depreciation, this is a very important term. This is just the total depreciation of an asset over time. Okay, so in other words, it's the total amount of value that an asset lost up until a specific point in time. Okay. Carrying or book value, this is another very important definition. This is the original cost price of an asset minus the total value that it's lost so far. In other words, this is how much an asset is worth at a specific point in time. The value that it carries right now, or its book value right now. Okay, so you take its original cost price, the amount that you paid for it, minus the total value that it's lost so far. Residual amount. Now this is important, and I know Mrs. DeMelon actually caught some of the boys with this one last year. Its residual value is that in a business books, we can never ever reflect an asset at 0 rands. Okay, so we can't say an asset has no value to the business. We can only depreciate assets up until it has a value of 1 rand. So there's always a little bit left. Then depreciable amount. So what the depreciable amount is how much value an asset can lose during its useful life. Okay, so if we take the total cost of an asset minus its residual value, in other words, minus 1 rand, then that is the amount that it can depreciate over its useful life. Appreciation is when an asset increases in value over time, and that's applicable to land and buildings, and we will deal with that. Well, we won't deal with that in school, you'll deal with that at university. Two methods of calculating depreciation, which is what this whole slideshow is actually about. We've got the straight line method, and I always say that this method is the straightforward method. It's easy, it's just the percentage of calculation, nothing funny. And then we've got what we call the diminishing balance method, which is a little bit different. Okay, so the straight line method, there are quite a few synonyms for this method, and we can state either one in a question. Okay, so we can also call it the cost price method, the fixed cost method, or the fixed installment method. Okay, and what this means is that depreciation is calculated on the cost price of an asset each year. Okay, so the business decided that the asset will lose the same amount of value every single year, and that value is calculated as a percentage of its cost price, okay, for every year. That's why we can call it the cost price method or the fixed cost method, because depreciation will stay the same every year, or the fixed installment method. Okay, so the asset will depreciate at a fixed rate over its useful life. For example, if a vehicle depreciates at 20% per annum over 5 years. Okay, so let's say the vehicle cost us 100,000 Rand, then we will write 20,000 Rand off in the first year, 20,000 Rand in the second year, 20,000 in the third year, 20,000 in the fourth year, and 20,000 in the fifth year. It's a straight line method, straightforward. Then the diminishing balance method is also called the reducing balance method, the carrying value method, the book value method, or the declining method. And the reason why I'm giving you these synonyms is because last year the boys read a transaction that didn't say diminishing balance method but book value method, and then they were completely confused. Okay, so these synonyms are very important. Now, what diminishing balance method is that depreciation is calculated on the carrying value of an asset each year. Okay, so we don't calculate depreciation on the same value every year. Okay, we calculate depreciation of an asset on the value that it's worth when the financial year starts. And because it's worth the most at the beginning, and then as it decreases its value, it's worth less and less and less, we also call it the reducing balance method. Or because we are calculating it on carrying value, we're calling it the carrying value method or the book value method. Okay, so carrying value, remember what it is. It's the original cost price of an asset minus all of the depreciation that it had up until this point in time. In other words, minus all of its accumulated depreciation. Okay, so the asset will depreciate based on how much it's worth over its useful life. And now I'm going to show you some examples which would help you to make more sense of all of this. Okay, but this slide is very important. If you can, I would recommend that you print it and that you paste it somewhere so that you can look at it and go through it on a regular basis. Look at the straight line or the cost price method. It says ZZ Traders bought a delivery van for 30,000 Rand and a motorcycle for 8,000 Rand on the 1st of June 2019. And you have to calculate the depreciation for both assets on 31 May 2020, in other words, a full financial year later, at 20% per annum on cost price. Okay, so on cost price in this transaction would have given you the clue that you have to apply the straight line method or the cost price method. Okay, so let's focus on the delivery van first. Now, the depreciation calculation is very similar to the interest calculation. Okay, so the calculation is actually equal to the cost price of an asset multiplied by the rate, which in this case is 20%, multiplied by the amount of months over 12. And the reason why I brought that in here is because later on we will deal with depreciation for vehicles or assets that we've bought during a financial year. In this example, it's straightforward. We had the vehicle for the full 12 months from 1 June 2019 to 31 May 2020. But I want you to get used to the full depreciation calculation. Okay, so in this case, for the delivery van, the cost price was 30,000 Rand. We multiplied by a rate of 20%, which is 20 over 100, and we had the van for the full 12 months, so it's multiplied by 12 over 12. Therefore, it depreciated with 6,000 Rand for this year, and that 6,000 Rand will be written off as an expense. Then the motorcycle, you apply the same calculation. Okay, and the motorcycle's cost price was 8,000 Rand. The rate is still 20%, and the amount of months is still 12 months because you bought it on 1 June 2019, and we're calculating depreciation at the end of the financial year, 31 May 2020. Okay, and then I just said that the delivery van will depreciate by 6,000 Rand every year for the next 5 years. Okay, because it's the straight line method. So every single year you will calculate depreciation on the 30,000 Rand on its cost price. And the motorcycle will depreciate by 1,600 Rand every year for the next 5 years until they've reached their residual value. The diminishing balance method or the carrying value method, I'm going to explain to you by using a table. Okay, so I said ZZ Traders bought a vehicle for 200,000 Rand on the 1st of June 2017. Okay, calculate the vehicle's depreciation at 25%. Okay, maybe you should highlight that 25% on carrying value. Okay, so carrying value would have given you the clue that you have to use this diminishing balance method on 31 May 2018, 31 May 2019, and 31 May 2020. Okay, so now I'm actually asking you to calculate depreciation for 3 financial years because you bought it in 2017 and you have to calculate 2018, 19, and 20. So if you look at the cost price, it's 200,000 Rand when we bought this asset on the 1st of June 2017. Now when we calculate depreciation at 31 May 2018, what we will do is we will use the same formula, depreciation equals the carrying value multiplied by the rate multiplied by the amount of months. But because this is the first year, the carrying value when the year started would have been the cost price. Okay, so for diminishing balance, the first year is always the same as the cost price method, but after that it changes a little bit. Okay, so when the year started, the vehicle had a value of 200,000 Rand. We multiplied by a rate of 25%. We had it for the full year, so we multiplied by 12 over 12, which gives us a depreciation value of 50,000 Rand. Now the accumulated depreciation on the 31st of May, which means the total depreciation of this vehicle by the end of May 2018, is 50,000 Rand because it only depreciated this year. Okay, we didn't have it before this year. And the carrying value is now calculated as cost price, which is 200,000 Rand, minus accumulated depreciation, which is 50,000 Rand. Okay, so the carrying value is 150,000 Rand. Now, when the next year starts, the cost price didn't change. It's still 200,000 Rand. We are now on 31 May 2019. But when we do the depreciation calculation, we won't do it using 200,000 Rand as the carrying value, because when this financial year started, the carrying value was actually 150,000 Rand. So I want you to notice this, that now I use 150,000 Rand in my depreciation calculation. So I multiply that by 25% for a full year, and I get depreciation of 37,500. Can you see why they call it the diminishing balance or the reducing balance method? Because the depreciation is now smaller in the second year because we are calculating it on a smaller carrying value. Now the accumulated depreciation for this vehicle, in other words, the total amount that it depreciated with so far, is the 50,000 Rand that it depreciated with last year, plus, oh, there's a mistake. Sorry, plus the 37,500 Rand that it depreciated with this year, gives us a total accumulated depreciation of 87,500 Rand. And now when you have to calculate the new carrying value, you will say 200,000 Rand is the cost price minus 87,500 Rand gives you a carrying value of 112,500. So that's how much the vehicle is worth at the end of May 2019, when the new financial year starts. In the new year, the cost price is still 200,000 Rand, but now the date is the 31st of May 2020. Okay, and if we calculate depreciation for this financial year, we will use a carrying value of 112,500 Rand in our formula. Okay, so you multiply 112,500 by 25% for a full year, and it gives you depreciation of 28,125 Rand. If you calculate the total value that the vehicle has lost so far, you have to take last year's accumulated depreciation, okay, because that's how much value it lost at the end of last year, and then you add this year's depreciation to it to give you the total value of depreciation at the end of this year. Don't go and add 50,000 Rand again. Don't say 50,000 plus 87,500 plus 28,125, because 50,000 is already added in here. Okay, so that gives you total accumulated depreciation of 115,625 Rand. And if you want to calculate the carrying value of the vehicle at the end of 2020, or the 2020 financial year, then you have to say 200,000 Rand minus the 115,625 gives you a carrying value of 84,375 Rand. And if you had to do depreciation for the next financial year, you would have used the latest carrying value to do that. For depreciation calculations, for now, there's going to be a quiz on Google Classroom, and I want you to go and do that. And if you need to, you can come back to this video as you go.